Your dollar just bought half of what it did a decade ago. You feel it at the gas pump, at the grocery store, in your rent check. The official narrative? Inflation is complicated. Supply chains, pandemic disruptions, corporate greed maybe. But what if I told you there's a pattern? A documented recurring cycle where the dollar loses approximately 50% of its purchasing power, and Wall Street doesn't just survive it, they engineer massive profits from it. What if every major currency debasement event since 1971 wasn't an economic accident, but a wealth transfer mechanism built into the architecture of modern finance? Here's the uncomfortable truth they don't teach in economics class. When your dollar loses value, someone's asset portfolio explodes. When inflation eats your savings, someone's debt becomes cheaper and their holdings become priceless. And that someone isn't you. This isn't about left versus right politics. This is about a financial mechanism so elegant, so deeply embedded in Federal Reserve policy and Wall Street practice that most people never see it happening. They just feel poorer while watching billionaires add zeros to their net worth during the same crisis. Before we dive deep, drop a comment. Where are you watching from? And if you're tired of the filtered, sanitized financial news, hit that subscribe button. Because what you're about to learn doesn't make it to CNBC's prime time. Let's talk about the greatest recurring heist in financial history and why it's about to happen again. Let's rewind to August 15th, 1971. President Nixon closes the gold window. The United States officially abandons the gold standard. The Bretton Woods system, where every dollar was theoretically backed by gold at $35 per ounce, collapses overnight. The official story? This was necessary, flexible, modern. It allowed the government to respond to economic crises without the constraint of gold reserves. They sold it as liberation from an archaic system. But here's what actually happened. The dollar became a pure fiat currency. Its value was now determined not by gold reserves, but by government decree and, more importantly, by the Federal Reserve's printing press. And in that single moment, a new game began. Between 1971 and 1980, the dollar lost over 50% of its purchasing power. Gold, which had been fixed at $35 per ounce, skyrocketed to $850 by January 1980. Oil prices quadrupled in 1973 and doubled again by 1979. The average American saw their savings evaporate. But Wall Street, major investment banks, institutional investors, and those positioned in commodities, real estate, and financial derivatives made fortunes. How? Because when currency debases, asset prices inflate. And Wall Street doesn't hold currency. They hold assets and debt instruments. Sound familiar? Fast forward to 2008. The financial crisis hits. The Federal Reserve's response? Quantitative easing. Between 2008 and 2014, the Fed creates $3.5 trillion out of thin air. They call it liquidity injection and stimulus. The official narrative, saving the economy from collapse. What actually happened? The S&P 500 tripled from its 2009 lows. Corporate bond values soared. Real estate in major markets exploded. But the median wage barely moved. The purchasing power of the average household declined. The dollar didn't collapse overnight like in Weimar Germany. That's not how modern currency debasement works. It's slow, gradual. So 3% inflation rate here, 4 or 5% there. Over a decade, that's another 30-40% of your purchasing power gone. But during that same period, financial assets held by institutions appreciated 200-300%. Sound familiar? Now let's talk about 2020-2024. The COVID pandemic hits. The Federal Reserve unleashes unprecedented monetary expansion. In just 18 months, they print more dollars than existed in the entire money supply in 2008. $5 trillion in stimulus, quantitative easing, corporate bond purchases. Official inflation numbers claim 8% in 2022. But anyone buying food, housing, or healthcare knows the real number feels closer to 20 to 30% for essential goods. Your dollar in 2024 buys roughly 50 to 60% of what it did in 2019. But here's the kicker. During this period of economic crisis, billionaire wealth increased by $1.7 trillion as the stock market hit all-time highs. Corporate profits reached record levels. The financial sector posted bonuses that exceeded pre-pandemic numbers. Sound familiar yet? This isn't 3 separate events. This is the same play, run over and over again. Every 10, 15 years, there's a crisis. Every crisis requires massive monetary expansion. Every expansion debases the currency. Every debasement transfers wealth from ordinary people holding dollars to financial institutions holding assets and debt. The pattern is undeniable. 1971 to 1980, dollar loses 50% plus. Gold commodities holders get rich. 2000-2010, 2 recessions, massive Fed intervention, asset prices soar. 2008-2020, QE era, dollar weakens, financial assets triple. 2020-2024. Pandemic printing, inflation crisis, billionaire wealth explodes. See the cycle? Every single time the dollar loses significant value, Wall Street doesn't just survive, they profit massively. And every single time, the Federal Reserve's solution sets up the next cycle. But here's what they never explain. This isn't a bug. It's not an unintended consequence. It's the fundamental architecture of how modern finance works. And to understand why, we need to talk about the mechanism they never want you to understand. So, how does this actually work? How does Wall Street consistently profit from the same crisis that devastates ordinary Americans? The answer lies in a concept most people never learn: the debt-asset inflation spiral. Here's the setup. Wall Street banks and financial institutions don't operate like you do. When you have money, you spend it or save it. When they have money, they leverage it. They borrow against it at 10 to 1, 20 to 1, sometimes 30 to 1 ratios. This is legal for them, catastrophic for you. But here's where it gets diabolical. They don't borrow to buy consumer goods that depreciate. They borrow to buy assets that appreciate. Stocks, bonds, real estate, commodities, derivatives. And here's the key insight most people miss. When the Federal Reserve expands the money supply, when they print money, it doesn't show up in your bank account. It flows to banks first, primary dealers, financial institutions. They get first access to newly created capital at near zero interest rates. So let's play this out. A major bank borrows $1 billion at 0.25% interest from the Fed. They immediately deploy this into assets: corporate bonds yielding 4%, dividend stocks, real estate trusts, commodity futures. The currency begins to debase, inflation rises, those assets start appreciating not just from genuine demand, but from monetary inflation itself. Now, 5 years later, that $1 billion in assets is now worth $1.5 billion. But here's the magic trick. The $1 billion debt, still $1 billion, except now, because of inflation, that $1 billion in nominal terms is worth only $700 million in real purchasing power. They pay back cheaper dollars. They keep appreciating assets. You pay higher prices with the same stagnant wages. But the mechanism goes even deeper than simple leverage. There's a name for the institutional framework that makes this legal, systematic, and protected. There's a reason why, every time there's a crisis, the Federal Reserve's first move is to ensure bank liquidity, not household liquidity. And the receipts? The documented evidence of this system operating exactly as designed? You won't believe the name that appears on the key policy papers from 1971, 2008, and 2020. Stick with me. Let's break down exactly how the debt-asset inflation spiral functions as a wealth transfer mechanism. This is the section they don't want you to understand because once you see it, you can't unsee it. Mechanism 1. Liquidity access. Hierarchy. When the Federal Reserve creates new money, it doesn't get distributed equally. There's a hierarchy. First tier, primary dealers, major banks like JP Morgan, Goldman Sachs, Bank of America. They get direct access to Federal Reserve facilities, discount windows, and bond purchasing programs. Second tier, institutional investors, hedge funds, private equity, pension funds managing billions. They get access through the primary dealers at slightly higher rates. Third tier, corporations with investment-grade credit ratings. They can issue bonds that the Fed will purchase or that institutions will buy with cheap Fed money. Fourth tier, you. By the time new money reaches the consumer economy through wage increases or direct stimulus, the asset price inflation has already occurred. This isn't conspiracy theory. This is documented Federal Reserve operational procedure. Here's a real number. In 2020, the Federal Reserve purchased $1.6 trillion in mortgage-backed securities. Who owned those securities? Major banks. Who benefited from that $1.6 trillion in liquidity? The institutions that held the debt instruments. Meanwhile, the average American got a one-time $200 check. Mechanism 2. The leverage multiplier. Let's use a concrete example. Say you have $100,000 in savings. You can buy $100,000 worth of assets. A down payment on a house, some stocks, maybe some gold. A major financial institution with $100,000, due to legal capital reserve requirements and leverage allowances, they can borrow against that $100,000 and control $2 million to $3 million in assets. This is called fractional reserve banking combined with shadow banking leverage. Now let's run the inflation scenario. Your position, $100,000 in cash. Inflation hits 7% annually for 5 years. Your purchasing power drops to roughly $70,000 in real terms. You've lost $30,000 in real wealth without spending a penny. Their position, $100,000 in capital leveraged to $2.5 million in assets. Stocks, bonds, real estate. Same 7% inflation. But asset prices inflate with monetary expansion. They appreciate 10 to 12% annually. After 5 years, that $2.5 million position is worth $4 million. They pay back the leverage with inflated, cheaper dollars, pocketing the $1.5 million gain. This is why billionaires get richer during inflation. It's not luck. It's the mathematical outcome of leverage applied to appreciating assets during currency debasement. Real numbers from the 2008-2020 period. S&P 500 gained 400%, 2009 to 2021. U.S. monetary base expanded by $3.5 trillion corporate bonds held by institutions appreciated 60 or was 80%. Meanwhile, real wages adjusted for inflation grew only 7% over the same period. Mechanism 3. The moral hazard of too big to fail. Here's where the system becomes truly parasitic. During every crisis, 1987, 2000, 2008, 2020, when over-leveraged financial institutions face collapse, the Federal Reserve intervenes. The term is lender of last resort. The practice is socializing losses while privatizing gains. 2008 is the textbook case. Major banks made trillions in profits during the housing bubble by packaging subprime mortgages into securities, leveraging them 30 to 1, and selling them globally. When the bubble popped, those same institutions faced bankruptcy. The response? The Federal Reserve and Treasury Department injected $700 billion via TARP, Troubled Asset Relief Program, provided $7.7 trillion in secret loans, not revealed until Bloomberg sued for the information in 2011, dropped interest rates to zero, allowing banks to borrow for free and lend at profit, purchased toxic assets at above market rates. The result? Every major bank that should have failed not only survived, but became larger and more powerful. By 2015, JP Morgan Chase's asset base had grown by 47%. Goldman Sachs posted record profits in 2009, the same year the unemployment rate hit 10%. This is moral hazard engineered into policy. If you make risky bets with extreme leverage and win, you keep the profits. If you lose, the Federal Reserve ensures you survive, often by devaluing the currency, which, as we've established, transfers wealth from savers to asset holders. Mechanism 4. The derivatives time bomb. Now we enter the truly complex territory. Financial derivatives. A derivative is a contract whose value is derived from an underlying asset, a stock, bond, commodity, or even another derivative. They're used for hedging risk and for speculation. But here's the scale that matters. As of 2023, the total notional value of the global derivatives market is estimated at $600 trillion to $1 quadrillion. That's not a typo. 1 quadrillion. For context, global GDP is around $100 trillion. These aren't just insurance policies, they're bets, highly leveraged bets. And when currency values fluctuate, when the dollar weakens, derivatives tied to foreign exchange, interest rates, and commodity prices become wildly profitable for those positioned correctly. Here's a simplified example. A bank holds currency swap derivatives, betting that the dollar will weaken against the euro. The Federal Reserve expands the money supply, devaluing the dollar. The euro strengthens. That derivative contract increases in value by 15 to 20%. The bank's $100 million position becomes $120 million. Multiply that across thousands of contracts. In 2022 alone, during the inflation surge, JP Morgan Chase reported $51 billion in revenue from its trading and investment banking divisions, much of it from derivatives contracts that profited from currency volatility and interest rate shifts. Mechanism 5. Asset collateral rehypothecation. This might be the most opaque part of the system, but it's critical to understanding how leverage multiplies. Rehypothecation is when a bank takes assets you've pledged as collateral, say stocks in your margin account, and uses them as collateral for their own borrowing. Then that institution's lender can rehypothecate again. The same asset becomes collateral for multiple loans simultaneously. In the US, rehypothecation is limited by regulation. In the UK and offshore jurisdictions, nearly unlimited. Estimates suggest that before 2008, $4 trillion in assets had been rehypothecated into a $40 trillion collateral web. Why does this matter for currency debasement? Because when the Fed injects liquidity and assets appreciate, that same asset, now worth more, becomes more valuable collateral, enabling even more leverage, enabling even more borrowing, creating a feedback loop of inflating asset prices, divorced from underlying economic productivity. You work harder, produce more, but your wages don't keep pace because the inflation isn't coming from real economic growth. It's coming from monetary expansion and financial leverage amplifying asset values. The engineered cycle, putting it all together, let's trace one complete cycle. 1. Economic shock occurs, tech bubble bursts, housing crisis, pandemic, etc. 2. Federal Reserve responds by slashing interest rates and expanding the money supply. quantitative easing, emergency lending facilities, etc. 3. Primary dealers and major banks access this cheap money first, borrowing at near zero rates. 4. They deploy capital into assets using 10 to 30x leverage, stocks, bonds, real estate, commodities, derivatives. 5. Monetary expansion creates inflation, devaluing the dollar's purchasing power. 6. Asset prices inflate faster than general consumer prices. Stocks, real estate, commodities all rise. 7. Institutions repay their debts with cheaper inflated dollars, while their asset holdings have appreciated 50, 200%. 8. Ordinary Americans experience wage stagnation and cost of living increases, losing purchasing power. 9. Profits are privatized. The next crisis emerges from over-leveraged positions. 10. Repeat. The Federal Reserve intervenes again, socializing losses, and the cycle continues. This isn't capitalism in any classical sense. Adam Smith didn't envision a system where the money supply itself becomes a tool for wealth transfer. This is financial engineering exploiting the gap between monetary policy and real economic productivity. And here's the most disturbing fact. It's completely legal. It's documented in Federal Reserve meeting minutes, bank earnings reports, and academic papers. In 2010, a study by economists at the University of California found that 93% of productivity gains between 2009 and 2012 went to the top 1% of earners, the exact period of maximum quantitative easing. The dollar loses value. Your savings erode. Their assets explode every single cycle. It's not a glitch. It's the system working exactly as designed. So where does that leave us now in 2024 and beyond? The Federal Reserve's balance sheet, the amount of assets they purchased with created money, sits at over $7 trillion. That's money that didn't exist before 2008, now permanently circulating in the financial system. The national debt has crossed $35 trillion, requiring perpetual monetary expansion just to service interest payments without economic collapse. We are living inside the longest, largest monetary experiment in human history. And every historical precedent, from Rome's denarius debasement to Weimar Germany to modern-day Venezuela, ends the same way. Currency crisis, wealth destruction for ordinary citizens, chaotic reorganization of the economic order. But here's the acceleration factor they don't mention. In the 1970s, financial markets were regional, mostly domestic. Information moved slowly. The next dollar debasement cycle will be instant, algorithmic, and global. High-frequency trading, digital currencies, derivatives markets moving billions in milliseconds. The stakes aren't just higher, they're existential. When the next crisis hits, and it will because the over-leveraged system guarantees it, the wealth transfer will be faster and more complete than anything we've seen. This isn't about fear, it's about awareness. Once you understand the mechanism, you can't unknow it. You can see it operating in real time. Every Federal Reserve announcement, every liquidity injection, every time they assure you they're managing inflation, you'll know what's really happening. The question is, what are you going to do with this information? Subscribe to this channel if you want more unfiltered financial truth. Share this video with someone who thinks inflation is just corporate greed or supply chain issues. Drop a comment with your biggest takeaway. I read every single one. And ask yourself the question they hope you never ask. Are we wiser now, or are we just walking the same path of currency debasement and financial manipulation in better suits with faster computers? The answer will determine whether you thrive or survive the next cycle. Stay sharp, stay skeptical, and I'll see you in the next one.